Franchise Secrets, Eric Von Horn.
In this episode of Franchise Secrets, I have David Lawver on. Now, super unique here. He's a franchisee with Crunch as an investor. Big real estate guy, has over $75 million of real estate projects. And he is an equity investor in the franchisee. And so he loves to buy the real estate, invest in the franchisee, and make a bunch of money along the way, both in real estate and at the franchisee level. We got into some of the things, how he's running his meetings with his operators. He does weekly meetings with them, 30 minutes each. And then he also does a weekly financial meeting with a CPA to go over each of these businesses. And so I think that's something that a lot of franchisees and franchisors are probably not doing to the extent that he's doing it. And it comes in handy when you're getting ready to sell to private equity like he is. So this is going to be a really interesting one. If you like real estate, you like franchising, and you like to pick really good operators and pick really good brands. We got into some brands that he's looking at for number 2, number 3, and number 4. Hope you enjoyed this episode. All right. So you do all kinds of stuff. You have a bunch of real estate projects, like $75 million in real estate projects, I think, from single family to retail to residential, commercial. You're doing stuff in franchising uniquely as a real estate investor and investor in franchises as a franchisee, specifically Crunch Fitness. So love to dive into some of that stuff, but why don't you give the audience a bit of your background?
Yeah, absolutely. And it's great to be on the show again. Round 2, let's go.
Yes.
And the quick background is I would consider myself a real estate man. So nearly 20 years in lending that transitioned into getting into real estate development and acquisitions that led ultimately to buying commercial real estate. Specifically, we like retail centers in particular. And as part of that journey, on the real estate side, the hard part about that asset class is finding a tenant that you believe in that will stick there and stay there and be successful long term. Also, we're looking for that type of partnership and scale. So franchises are perfect, where you can meet a franchisee who needs some help kind of expanding their business with capital, and we can go out and buy the real estate, provide some operating capital, and help that franchisee grow the business while we grow our real estate portfolio.
So what are you looking for in that franchise? Is it the franchisee that you're looking at? I'm sure it's more of the franchisor to fit specific things within your real estate portfolio first. And then obviously they got to be a good operator. Like, what are some of the things that you're looking for in the franchisor?
Yeah, I've never thought about what I weigh heavier, but I would, just off the top of my head, I would say it's probably even. And I say that because it starts with the franchisor in the sense that, do I believe in this business? So our 3 major things we're looking at in the business is it Amazon proof? Like, we obviously don't want to be putting Bed Bath & Beyond and Toys R Us in, which is obviously on the way out. Is it recession proof? As we're heading into what's becoming very clear that it's going to be some economic turmoil, how deep, nobody knows exactly, but we want to make sure we're not, the $250 a month yoga or the kind of want to have sort of things that can easily be replaced with cheaper stuff. And then the last piece is we like larger footprints. We don't have a minimum size, but from the real estate perspective, if it's an 800 foot square that someone's taking, it's not just creating a lot of impact for us. So we're not, it's just not our first decision. So those are our 3 criteria for the business itself. But for the we really care about the franchisee because that's who we're dealing with. That's our partner in the business. That's who we're interacting with on a day-to-day basis. And, the franchisor, we found, it's not really that involved. Maybe they can support you with this or that, but they're not there. And in the franchisee, we're looking for somebody who's got around, say, 1 to 5 stores, already has navigated the initial challenges of learning that particular franchise, is capital constrained in terms of expansion, but has the infrastructure and knowledge to expand, and wants somebody to come in and put gasoline on the fire and take them from, say, 3 to 10 stores.
So you've done this with one concept, one franchisee right now?
Yeah. So we started with Crunch Fitness. For anybody who doesn't know, is a big box gym, generally between 20 and 30,000 feet. Again, meets all our metrics. It's $9 a month, recession proof. It's Amazon proof. It's in-person gym. If Peloton was going to get them, they would have got them during COVID, and that didn't work. So we feel good about gyms right now. And so, it kind of meets all the things, and it's a, big box. So it meets all our things. That franchisee had quite a few stores. I believe it was 8 when we started. But it was definitely, the gyms are very high capital in terms of expansion. So we started this in 2018. Our first store landed in 2019. We've done 2 more stores in 2020. And we've essentially navigated those stores to maturity. And now we're in the process of exiting. So now we're kind of putting our heads together for our next round of gyms. And aside from that, we have 4 other concepts that we're in negotiations with or have signed deals with. So we're getting ready to bring other concepts into this portfolio.
New franchisees, different franchisee ownership, or same franchisees, different franchisors?
Different franchisors. We're looking for different concepts besides the gym.
So what can you give us any hint on what they are? Tell us what they are.
Yeah, one concept is a basketball concept. I would compare it to Topgolf in the sense that there's like a screen and games, and you're throwing the basketball or you're shooting it, and it's measuring your shots, and it kind of gamifies basketball. There's one concept that's a manufacturer that builds homes in a factory. So we'd love to buy the factory and lease that back to them. In a separate vertical, we're buying homes out of a factory. So if we could own that concept and be partners with the franchisee, we would be very, very happy. And again, huge footprint, 160,000 feet, and building homes in person. Again, all these check all the boxes. We have another concept we're talking to where essentially they do city contracts and they provide transportation for the cities. So but they need some very specific space in terms of, servicing some of the transportation needs. So again, checks all those boxes.
And those are all franchises?
Correct.
How do you get those deals? I'm always looking for deals, always looking for franchisors that are wanting help to grow the franchisor. How are you finding these deals? I think I know what basketball concept you're talking about. I'm not 100% sure. I've never heard of the other 2 that you have mentioned. So how do you get those deals?
To be honest, it's a pretty heavy lift going from hello to really in lock and step with each franchisee. And we got to, DD the whole franchisor, DD the franchisee, make a deal that makes sense for everybody. And then the real estate search doesn't happen overnight. So when we're getting into bed with these deals, it's a long road. I mean, you're talking about a 5-year journey with somebody pretty obviously, or longer, right? So most of them have come via referral. My story is kind of pretty widely known inside of a group called GoBundance. And as I've spoken to that group and on some of the stages and been on certain podcasts, people tend to call me and go, "Oh, the Crunch guy." And they kind of get this concept of commercial real estate with a tenant and expanding that way. And so just people kind of reach out, and it's been through some of the just kind of personal networks and podcasting and this sort of thing. But it's on my roadmap of either myself or a team member needs to be head of franchisee and be at all the franchise conferences, researching them, meeting operators. I mean, that could very easily be a full-time job.
So I would imagine after being on this podcast with a large franchising audience, you'll be getting a lot of people that want to reach out to you. Who do you want to reach out to you for what? And also who should not reach out to you? Is it the person that has the 1,200 foot Pilates studio should not be reaching out to you? Or who should and who should not? That way you get the right people and don't get blown up with the wrong people.
I like talking to people and I love interacting with aspiring entrepreneurs. So I tend not to exclude a phone call. And I may book out a little bit. If somebody reaches out that's not a fit, maybe it's a 4 or 6 week conversation out, but I'll happily take the conversation just because maybe we don't make a deal on that particular franchisee, but maybe I've got some fitness resources or they do, or there's some person we know and we link. And I'm just always happy to take those calls. So, I certainly don't want to exclude anyone, but yeah, sure. The criteria I laid out earlier is relatively self-evident. I mean, it's like, yes, a Pilates studio at $300 a month, it's 1,200 feet, it has 200 customers, it's really niche. And they only have one location, or maybe they're trying to get their first one. Like, it's, again, probably a little too early and probably not the right fit for a real estate partner.
These referrals that you got from the basketball, the manufactured homes, and the city contract transportation deal, are those all proven entrepreneurs, or are some of them first-time entrepreneurs going into a franchise?
All of them have multiple locations now, and now they're growing. So we can dig into this a little bit. So I'm going to take the gym concept for just a second, and we're going to do it by the numbers, because I think this will demonstrate for everybody like how we're looking at it. So a gym loosely costs $2 million to build out.
So we're talking big box gym, not a boot camp thing or whatever. We're talking big box gym, typically $2 million to build out.
Yeah, I'm going to say that very loosely because size, location, blah, blah, blah. But let's just say it costs $2 million to build out. Let's say a really good gym, or, a normal standard gym does $400,000 in EBITDA. It's a 20% profit rate on the initial investment. That would be a decent, 5-to-1 multiple for an investor, 20% return. That would be a decent return for the capital in, and, it'd be okay. But the person who's making $400K a year and probably has 2 partners, after tax, that 400 is really only 200. And then people still have to pay their bills, unless they're working in the business and have a salary. But the reality is trying to turn that 400 in EBITDA into the 2 million it takes to get the next store is very, very difficult. On our side of things, it's like we're saying, hey, listen, if this business can pay market rent and it's going to make EBITDA for you, we're okay putting the $2 million in because we're focused on the real estate asset. And, maybe we're putting some money into OpEx and where there's some partnership on the business as well. We'll look at both. But for us, that makes sense. So this person who's like, well, I've got a great business. I've got 1 or 2 or 3 stores. I know I can expand it. I just need the right partner. We're the partner for that deal because we'll put that initial capital up. And if somebody can move it to, EBITDA positive quickly, like that's our dream partner.
That's perfect. So, and I invest in partnerships like that too. Typically on the franchising side, if I'm going in on the franchisee side of things, it is with partners that are already proven in that particular concept. So I'm the same as you. How big is that basketball one? What kind of footprint do they have?
The franchisee or the franchisor?
Franchisee. Like, what's the square footage on that?
It ranges from 10 to 20.
Wow.
And depends on if they want a half court or not.
Yeah.
So 20 is it's good. Yeah, we're fine with that. 20 is a lot. I mean, there's concepts we're talking to that I didn't mention because we're not far enough along in a deal, but they're sort of medical type concepts, medical, that sort of thing. And, they're 5,000 feet. I mean, it's a little small, but like the business is really profitable and we trust the direction of it. That particular business, that industry is getting 10 multiples. So, right now on roll-ups. So 5,000 is a little small for us, but we like where the industry's headed. So, we'll look at that smaller footprint.
So when you're saying medical, are you talking like Botox and, those types of those injectables and things like that?
Yeah, something like that. Like med spa-ish with a couple of little unique twists.
Yep. They've got to have some unique twists to them.
I don't know. Does Crunch have a unique twist?
I guess Crunch doesn't. I guess they either have to have a unique twist or a very strong second or third to market.
Right.
Where there's a salon suite space. They had it was Sola, Phoenix and Sola. Sola, in my opinion, was better. Then they had some others that came to market right after that. My Salon Suites, which was very strong, very, very similar to Sola. And there's some others as well. So I would say, no, you don't need something that's super unique, especially in the franchising world. Sometimes you do if you want to stand out, depending on it. But no, you don't need to. Like Crunch is the competitor there is a Planet, right?
Sure. And Planet or say Gold's, and they're
True.
kind of Gold's quality, but but Planet price. And they're kind of this like sort of unique middle ground.
Do you kind of stay out of each other's markets?
No, I've learned that in the first 3 stores at the gyms. It's actually the main key. Like you need 7,000 members at a store to make good money. That's a lot of members. And, people are going to drive 10 minutes or whatever for a gym, maybe max. So if there's 10 stores in town, it doesn't matter if your concept's the best. Like people are probably picking the one 3 minutes, not 6 minutes. So in the gym business, a lot of the site selection is about just like how much competition is there, what's the population in a 10-minute drive, and like how do we not like stick ourselves in a place where we're all cannibalizing each other.
Let's talk about site selection, because it's easy for leasing people to come on here and talk about site selection because they get commission when someone leases a site. When you're talking about investing into a shopping center or commercial real estate, you're not just, you're not a leasing agent. Like that's a whole different game. And then you're also investing in the concept that goes into it. What kind of tools and data are you really looking at to make sure that location is the right one? What's like, are there, I know there's Gibbous, there's, number of different types of software out there. So what do you do?
Okay. Yeah. So I'm going to hit that question. I'm going to step back a little too. You also mentioned, do you need a secret sauce? And then I'll get to site selection. So my best way to describe it is like In-N-Out or, I don't know, Southwest Airlines, maybe. There's just these certain businesses that like In-N-Out. I don't know why. Chick-fil-A, there's just always a line. Like when I go eat Chick-fil-A, it's like fried chicken and the sauce is like, okay, but like it's whatever. But there's just certain businesses that just have like a cult following. It's an it factor. People love it. People love it in multiple locations. Like you could just, I can generally feel when I walk into something and I'm like, oh, this is one of them. And they're all over the place. And it's just the thing that just, no matter what, everybody loves. So it could, but I don't think Chick-fil-A is any better than Kentucky Fried Chicken or any of the other chicken that I've tasted. So it's just whatever it is, it's got its own magic. But then in terms of site selection, if a business really has the magic, i.e. a Chick-fil-A, I mean, I think site selection matters, but maybe less because it's like, the business is just so good. You kind of build it and people will come. So I think there's some of that. But then there are businesses like the gyms, which are very site selection heavy. Your comment earlier about the leasing agent maybe not being on your team. But you know what else is not on your team is the franchisor. They have a real estate department that will tell you if a site's going to work or not, but their whole motivation is selling units. And all they want to do is opening doors. Some head of real estate's got to do 100 stores this year and he gets his bonus. Like they're not helpful. So as a franchisee, if you're thinking like you're aligned interests with the franchisor, what do they care if you close the store? It's your money that got invested. You're the one who loses. Yeah, they lose some royalties or whatever, but they got their per unit fee and blah, blah, blah. Like that, I would say that's like, definitely a conflict of interest, and certainly both your broker and your franchisor likely are not aligned with you on picking a site. I'm with you. I've seen a lot of these studies. It does seem like there should be data out there that would just say, hey, here's the right store. The best one I've seen, I think, is Geo Studies. It's relatively expensive. I guess they all kind of are, but I think that one's pretty good in terms of site selection. But yeah, in terms of the gyms, that's like our major thing is like, you got to get the right site.
What do you look for? Like, what do you look for that like the average person may not be aware of? I mean, it's drive time. It's where they live. I mean, it's always the things of the AGI and, those types of demographics. But what are some of the things that people may not realize that you really look for?
Say gyms. I think it's like the demographic, the income, and then how much competition. It's just a math problem. You need 7,000 $20 a month members. If there's only 15,000 people in the town and there's 3 other stores, like you're just 3 other competing gyms, like you're just not going to make money. You're not going to get your member count. There's just not enough dollars there. And And so, it's that type of stuff. It's funny though, man. There's certain gyms that like we went exactly by the franchise standards and it was supposed to be a great store and it wasn't. And then there's some that look like they were just going to be okay and the store was a home run. But to me, I think it's just population dollars within a geography versus competition.
What do you think were some of those things that, why was that not a good location or a better location than the one that you thought, why did the better location was not actually the better location?
Because even though the metrics that we started with were you need 150,000 people in a 3-mile radius and you want median income between 60 and 80, I'm just kind of making up numbers, but something like that. I don't think those were the right metrics. I think you also need to factor in, 5 gyms or less inside of that metric. If there's 8, you're probably host. It's kind of just competition in dollars.
And so you learned that after the fact.
After the fact.
And then you learn that by yourself, like within the system. Have you talked to people and like, oh yeah, that's what, or have you educated other people on that?
I've talked to a lot of franchisees in different verticals, and no one seems to like go, I've got the magic with site selection. I mean, you're in this space more than I am. I mean, I'm the real estate guy, just show up, right? But do you feel like there's franchisees you're a part of where they're like, yep, we've got this magic pill and there's a data you could pull. And if you put it inside of these metrics, like every time you're getting a high profit store, like, is it that simple? Are there businesses that are that simple?
No, I don't think it's that simple because there's things that you just, there's other things that come into play. And like, to your point, it's always after the fact. You're always learning, always growing. That's why I always like to talk to franchisees and just like, what are you learning? What did you learn from site selection? Even like this, that's why I want to learn, like competition. Same thing going on right now in the cookie industry. Like there's certain markets in the country where cookies, the stores are declining because the competition is so high. There's too much competition. And in the cookie market, there's not necessarily the loyalty that the brands think that there is. It's, to your point, it's where can I get the cookie the closest? So proximity matters in that world too. And so I know in different markets around the country that, and talking to multiple franchisees and founders in that industry, like competition does matter. So that's why I kind of wanted to hang out here for a little bit, because I think that is a bigger thing than what some people may realize. You do want competition because it's the old McDonald's Burger King thing. Where does Burger King go? They went where McDonald's was. And we did that in the tax business. But, when there's too much competition or cannibalization, that really does have an impact. Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisor and you're frustrated that you're not awarding as many franchises as you thought you would, this is the reason I created the Franchisor Mastermind. If you want access to the information, the techniques that the best franchise sales organizations are using to award franchises, and you want what mature brands have with their playbook of having happy, successful franchisees that grow the right way, then you might want to check out the Franchisor Mastermind. The reason why people join is they want access to my Rolodex, my connections. They want the playbook to achieve both short-term and long-term success. They want to increase enterprise value in their brand. Links will be in the show notes or at scalablefranchise.com.
Yeah, it's maybe McDonald's, Burger King was fine, but then when Chick-fil-A and Jack in the Box go across the street, it starts to become too much. So it's like, where do you kind of find those runways where there's still enough room to grow and it's still a good community to bring these stores? Yeah, I could tell you in Pacific Beach, I lived for a while, and like a couple of cookie stores went in all right in a row. And the first one that went in was line out the door, and kind of anecdotally, not too long after, it wasn't line out the door because there was, 5 different doors to go to. And I think that tells the tale. But the data does help, because when you pull some of these back in, like a geostrategy study or the Experian data, which will spell out like, hey, in this market, here's the exact, demographics and money, and they rank them like by like what type of customer it is. you can at least get to like, okay, there's 1,000 households here that could use my services. Now, okay, 2 competitors is fine, but 5 may not be. So you're getting good data to decide if 2 or 5 competitors is okay. So I think it's like and studying the bad stores is where you find that, and the good ones, and kind of seeing where that intersection is. But I also think there's a little bit of a law of averages. Like you might say, hey, in this business, we're going to have 3 good stores and 3 okay ones and 3 bad ones. And holistically, we're profitable. It may be okay to have a bad store. It just sucks if the first store is the bad store. And then it's hard to have the commitment to continue on through to get to that, past the first bad one. Like in the gym business, we got lucky. Our first store is a home run. And so it's like, oh, we can't miss with this thing. And so, yeah, we've got a medium one and a bad one, but holistically, it's an okay portfolio, right? So
that's a good point. We're the same way. Like when we built out the salon suites in Orange County, we built 12 of them. First one was average. Second one was a dog. And the third one was a home run. It's just in different order than what you had. We had a average one, then a dog, and then a winner. But if we started out with the dog, we probably would have blamed it on the brand and been like, this was bad. By the way, the franchisor thought the dog, the one that became the dog location, was going to be the greatest location. And it was horrible. It was the one that we didn't make money at that for the longest time, where another one, we made money from day number 1. So you just, when you're getting into some of this stuff, like location matters, but you don't always get it right. There's too many other factors.
This speaks to the power of franchise, exactly what we're talking about, which is like, okay, if they've got 50 locations and your franchisee partner has 3 or 4, they're big enough where they can afford the studies, these more expensive study type groups, to go through and really say, hey, what sucked and what didn't, and give you real data about things to look for. And it's not going to be perfect, but at least you're getting a lot of trial and error, 3, 5, 7, 10 years of learning that you get to walk in the door with. I mean, that's the whole thing. It's like starting from scratch. Like you're losing 5 to 10 years, right? Like, and so I buy that concept, and I recognize that not every store will be a winner, but at least kind of hopefully shortcutting some of that and having operators that can help you shortcutting some of that. That's the whole thing point.
That's exactly it. As we're working with some of our brands at Front Street Equity Partners, they're buying some of this expensive mapping software. It's territory management software on the back end. It's site selection software on the front end for franchisees. And you load it up with data, your customer data, and it just gets smarter and smarter as you open up more locations. And then you can start to understand why some do well and some don't do as well. And I was reviewing some of it with some of the big hotel chains out there, and it was really interesting, the things that they track and how they track it and why they go certain places. And then they also have, one of them has a cannibalization study on the current brand. Like when you start to cannibalize, it starts to show you that, because you don't want to cannibalize your own market, especially as a multi-unit owner. You want to have some type of intelligence going in where you're going to put your second and third and fourth and fifth and sixth location versus just, thinking where it should go. Then you got to look at other things too, trends. In Austin, I had tax offices, which was low income locations next to check cashers and pawn shops. And that was all in East Austin, East 7th Street, East Old Torf, East Riverside. And now that's no longer like low income stuff.
It was the
right demographic, but not today. So, there's so many things that go into it, but you do the best that you can with what you have.
Yeah, I agree.
All right. So what do you like more? Cash flow, building equity, enterprise value for an exit? Like what do you like?
From the perspective of the real estate, and especially if I'm capital partner, I am a huge cash flow business guy. Even though I grew up in Silicon Valley and I've seen how, I'll call it the Amazon model, which is you burn, raise, and then all of a sudden you're a Goliath and you own the market. Like I know you can do that and it works, but like how many unicorns are there? And then how many unicorns are there that don't eventually die not that long, but by getting usurped by some future software? It's a very hard business model. I've always been old school. My original mentors are old school guys that are just like, you have your P&L, you study your numbers, you stay tight, you make profit. And you count your profit out first before you're spending money. Like, it's like run a business with cash flow. And so, that is my base. The idea of like no profit business drives me crazy. And I do understand running for equity, but like, especially as the real estate partner needing to get my rent, I need businesses that pay. And then as there's an exit value and maybe it's only a 5 multiple, but like, I'll take a 5 multiple of something that's generating cash over, say, trying to get some 10 or 15 or 20 times multiple, with some other kind of tech forward idea. Although, as you were talking earlier about feeding data into a site selection software, man, if somebody could take that data and interface it with a strong AI, I bet you there'd be some really incredible revelations. And I bet we're not too far away from much more sophisticated site selection that would be helpful for these ventures and really any journey.
Oh yeah, I agree on that. All right, let's shift gears a little bit. You got a lot going on. You do a lot of investments, a lot of real estate, and then you have operators and team members. Like, how do you manage all of this stuff?
It's all in the partner. So when you asked, is it franchisor or franchisee? Of course, I want to believe in the core business, but man, franchisee is everything. Mm-hmm. And I think certainly we could go through a bunch of cadences of how we do that. Like it's a weekly meeting with each kind of partner or partnership group. We do quarterly offsite meetings where we go through any one of these BTO models or, traction or, Rockefeller method, and any of these methods where you create a vision and check it in a quarter and then you have weekly check-ins, whatever. And certainly different partnership groups are better at those than others. Like, sometimes it's hard to keep people on a cadence or schedule, but so all that you could point at what's better or worse or working better or not. But for me, are the values aligned? Are they executors? Do they do what they say when they say? Do they have integrity? And that's integrity in action. Like if they say they're going to send this thing on Wednesday, they send it on Wednesday or re-promise prior to date being missed. Are they like super passionate about the business? I think there's just some like core fundamental alignments in terms of like how people are, that if that's there, the concept's there, they have enough experience, I think it just works. But the management piece, it's a quarterly offsite meeting. It's a weekly meeting with each partner, and we run all of those follow-ups inside of Asana, which is our software that we do that in.
How long is a weekly meeting with an operator?
30 minutes.
Quarterly, is that offsite?
I prefer it to be offsite. We've done some Zooms. I find the Zooms to be significantly less effective, but I prefer. I was actually planning on setting up one like in San Diego and then just inviting all the partners and actually having everyone be in the same room, even from different verticals, and just hiring a third party to run it. And each person's kind of writing their own plan, but with not me running. So, that's kind of the next step, but
I like that.
Yeah.
So how many 30-minute weekly meetings do you have?
Monday, Tuesday is like basically cadenced meetings. Monday's mostly partner meetings, and then Tuesdays, a little bit of partner meetings and a lot of accounting meetings. Oh, I guess that's part 2. A lot of it is counting the money, right? So now you're looking at P&Ls, balance sheets, cash flow, cash management, just making sure everything's kind of moving.
Talk about like what you do because I don't think a lot of business owners are really good at that. So give us some insight into how you view that and what kind of the priority that you put on that and what you actually do.
Money meetings, everything. Okay. Like I said, I'm an old school P&L, count the money, like make sure there's profit guy. So I would say the simplest way to put it is, there's themed meetings each week of the month, week 1, 2, 3, 4. Week 1, maybe check all the bills that were paid. Week 2, maybe look over the profit and loss from the month before to just kind of see where your expenses and explore any cuts or, if everything's making sense. Week 3, maybe like projections or asset review or, something along those lines. So just whatever that cadence is of the things that business needs to be thinking about, those are there. And then after the weekly rocks, then it's just loose questions. And usually accountants are, got their questions, but it's just counting the money. And again, those are half an hour.
So those are half an hour. So the one is with the operator. The second one is kind of with the controller, the accountant, the CPA that is counting the money.
Right. And sometimes the operators sit in on the money meeting. Sometimes they don't.
How many people do you think are doing the money meetings? Like when you talk to people out there, operators, how many operators, business owners are doing the money meetings?
A weekly money meeting where they're counting the money?
Yeah.
Oh man, I don't know. When I say my original mentor, he runs a program where he coaches people who run mortgage businesses. So there's like 500 students there, and I think 300 are in the lending business. So all 300 of us all run these cadence meetings, like exactly as he says, because he's a good mentor. And so I'm just used to being around people that operate that way and have consistency and balance and run business that way. So it's hard for me to say, but you're right. Yeah,
go ahead.
It's hard, but you're right, because you're meeting other operators and then going into business with a new partnership, and maybe they have different ideas of how they handle things. It is sometimes hard to pull somebody into a cadence like that.
So what are some of the things that you are getting out of the counting the money weekly meetings? Like the things that you've discovered or the things that you've avoided by having those? Why should people be doing that?
It's so valuable. One, cut an expense every month, no matter what. It could be updating the paper shredding bill, like cut one expense a month. I think is just always being in a ferocious interaction with cutting expenses, I think is key beyond belief. I think two, you ever watched a Shark Tank episode where they're asking somebody their numbers?
Yep.
And they can't answer? Like, it's so bad. It's so bad. Like if I ever meet a franchisee and I'm like, oh, what's your revenue last month? And what's your cost of goods? And they don't know those answers, I'm like running for the hills. There's this really beautiful thing that comes from when you look at the numbers every week and you look at them on like a weekly and monthly cadence, you feel the trends and you can just like immediately feel when something's wrong. You just see the numbers and you go, oh, still drop. And you're just on the call with the sales team. Hey, we're down. Let's do a promo. Let's do this, and that. Or you see expenses. It's so clear. It's so clear. I don't know how to describe it, but you have to see it every week to where you're just that in tune with the numbers.
So on those meetings, the first one is kind of making sure the bills are paid. And this is your financial person going over it with you. It's not you, Dave. You're looking at it. I imagine it's on Zoom or in person. They're going over the financials and they're saying, this has all been done. We're late on this, or we're doing this, and this is why. And then you go over the P&L, over some bills. The next week it's projection, asset review, meaning like how the asset is performing, maybe what the enterprise value is worth, or just
sure.
And then the last week is just questions, just in general, just kind of making sure any kind of loose ends. If you're doing traction, it's like, what are the things that we're supposed to be doing that aren't getting done?
Moving the needle here. Like maybe we're installing a new accounting software for investors, or whatever. There may be some bigger project that goes in there if there's free weeks. But and by the way, a business that's in its first month is going to have a very different 4-week cadence than a business that's in its 15th year. So it's going to be different.
Yep. So this, I would imagine, is really nice when it comes time to sell. You have people looking at buying your crunches or whatever it is, because you have things so buttoned up. It makes selling this much easier than if you had a mess of financials.
Yeah, we're actually in negotiations with private equity about selling a couple of our crunch stores, and we have a term sheet out. There's still conversations running around, but we were able to put together a book of like member counts by month, financials were ready to go, like clean match tax returns. Like, it was not a huge project to be prepared to give them numbers. And maybe private equity is used to walking into businesses where maybe it's a gym operator who's not as financially savvy and they're used to kind of having to piece things together themselves. And maybe they have teams for that. But I could say, as a person trying to sell a business, if you want to get the highest valuation, having your numbers look clean. As a buyer, you're going, hey, this makes a lot of sense.
So let's shift gears away from the numbers, kind of last topic. How do you structure a deal with an operator?
Yeah, great topic and good one to finish on. I think each deal's totally separate. So I think every party, even though oftentimes I'm involved on multiple sides, should be as fair to market as possible. Meaning like if, say on a gym, $2 million is contributed, and say a normal gym valuation is $4 million, the $2 million that went into the gym should get 50% of the gym. Kind of similar if the gym had to go replace that capital with raised money, and that's what kind of market for that money is, that's how that money should be treated. And also for the real estate, if market rents X, that's what the deal should be negotiated on with the gym. So, in any case, it's like, hey, sure, we'll be the landlord and here's what we think market rent is. Can we agree on that? Okay. Have you raised money previously? If so, at what valuation? How does that compare to the market? Is that reasonable? Okay. So if we put these dollars in here this way and this is market rent, does this make sense for all parties? And if so, I think, it's a fair way to kind of skin the cat.
How do you, when you're coming in with an operator, because I believe most of them or all of them have already been operating a particular franchise before, do you participate in any of their prior deals, or are those completely separate?
There have been pieces of these negotiations that have said, hey, you have an existing core business or core portfolio that looks great. If we add 3 or 5 stores per store, maybe we get a little piece of the existing business. But generally, the intention is not to go backwards. The reason that type of deal would be done is if it's like, maybe we're bringing certain resources to the table that they want to bring into their other businesses. And usually site one kind of is like, oh, you guys do this and that, or we like these weekly cadences, and can we get all our stuff wrapped into this? And how do we get alignment where everyone wants to be inside of this or this conversation? But, I think each store is its own store. That's at least how I've been doing it now, and trying to make each store its own fair valuation. But certainly there could be a negotiation backwards if it made sense for everybody.
What's the biggest thing that these franchisees have loved coming into your world?
Financial cadence. Well, it's nice to have books. Yeah. I don't know. Or capital. Shoot.
They're not used to capital. They're used to going to the bank, right? Going to the bank, and the banks, they could say no at any time for any reason. And so as long as they're performing, I'm sure you have capital that's ready to go, right?
That's right. And it's also based on, does the footprint work? But yeah, I'd actually say 3 things. I think it's 1, real estate site selection, because I'm good at finding the real estate, and most of them are in running the business. 2, construction management, getting a gym constructed. Like, I've heard worse horror stories of people trying to get a gym done and it takes 18 or 24 months. My construction team handles it because we're doing the real estate and we need it built and ready to go. And then 3, I'd say capital. Just these guys want to run a good business, not be, glad handing at country clubs. So, I think taking those things out of, kind of their cues and letting them do what they do well, which is run these businesses, I think is a good partnership.
Would you be looking at these other franchises right now if you hadn't had success with Crunch franchise location? Because you got, I think, what do you have, 3 or 4 possible deals or deals on the table? Is this because there's not many people doing this. That's why you go to these meetings and people will always give you deals, because there's not many people that are kind of stepping into both worlds like you. So you've got this niche, you're crushing it with Crunch, you're doing it with other things, how excited are you about this? And would you be doing this if you hadn't had that success with Crunch?
I'm not going to pretend like every deal doesn't have its bumps and bruises. Every entrepreneur has these great ideas, like this is going to be perfect. And then you get into it and you're always punched in the face in a million ways. So I will say I'm born with that resilience of taking those in stride and moving forward. So that could be part of it. And I don't think a bump would have deterred us. I think we would have figured it out because it's a good partnership. That being said, I am more, and by the way, in my personal real estate development, where we're buying and building spec homes and doing other things, that is a very high profit business. It would be very simple to just only do that. But I I like the idea of one, making income, and two, collecting assets, both real estate and business. So, and I'm going to say that as this commercial real estate bubble unwinds over the next 18 to 24 months, certainly an office is going to get smashed. I think retail and multifamily will have some pain, but maybe not as much. And so I think over the next 24 months, the ability to buy real estate at a really good discount and give my franchisee partners a really good lease rate, because that's what market will be at the time. We can lock in a really good deal for all parties over the next 24 months. And I'm gearing up for what I'd like to see as like a really explosive moment where, like, imagine 2010 to 12, you're like, hey, I'm going to just gear up and go nuts and buy 500 homes. You'd look really smart right now. And I think that's where we're at in this climate. Now it's scary and things are getting hard and shit's hitting the fan and it's only getting worse, but you can see that it's hit the fan. And when it's done hitting the fan, you have the guts to move forward and get into high acquisition mode. I think something really special is coming. So I'm high on this. I'm ready to go. I'm looking for great partners all the time. And I want to make deals.
I agree with you 100% on all that. How do people find you if they want to reach out and have that phone call?
I always give my Instagram on podcast. People can DM me. I check all my own DMs and I respond. And sometimes some of the bigger ones has been hundreds of messages, but I check them all. And so it's at Mr. Lawver, MRLAWVER, and happy to chat with anybody.
Awesome, man. Thanks for coming on.
All right, cool. Appreciate it. Love being on. Great seeing you.
Same. Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.